Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So still a little sick, trying to get on the other side of this, as I'm sure everybody seems to be sick right now. So I'm sure that is something that you've been dealing with as well. Today we have our FSC show, and we're going to talk about the FSC, what's happening in the U.S. as obviously things are slowing down for seasonal reasons. And then we're also going to look at the price cap, the Russian price cap, now that it's quote unquote officially agreed upon. What does it mean? And then some important data points, both domestically and abroad, that are really going to impact demand as we progress through the remainder of the year and well into obviously next year. So with that being said, the official frac spread count number is 290. So we went from 300 to 290. It's now, this might be shocking for those that aren't accustomed to it or don't really appreciate the seasonality of it, but typically those 6 weeks between Thanksgiving and New Year's Eve, you see a fairly steep decline of activity, and it can start the last week of Thanksgiving, the last week of November, the first week of December, and then you start to see a fairly sizable drop off that should get us to about 265, 270 spreads as we get into New Year's, and then we usually have a fairly sizable fairly sizable increase as we get into the second and third week of January. So here, when we look at things that are happening, realistically, the slowdowns came in the smaller entities, Denver, some of the other places were Appalachia, Anadarko. But when you look at the Permian, when you look at other parts of Texas, things are still fairly firm. So that's why the drop's not going to be too significant. But when we get much closer to Christmas, you get a sizable drop in the Permian that can be anywhere between 10 and 15. And then you get a quick snapback right after that. So again, very normal. The rate of change, if you want to look at other years, the rate of change is going to be slower just because we're coming from a much lower number than in previous times. So the slowdown won't be as aggressive this time around. Now, when we look at rig counts, rigs, there was a small drop. When you look at the activity, net, it was 0. But when you look at directional, there was a drop of, there was an increase of 1, vertical an increase of 2, but horizontal, which is the really important one, had a drop of 3. So that's why I said there was still a drop, and vertical gets picked up, they go drop the vertical well, and then they bring the horizontal behind it. Still fairly active. We will see some slowdown in activity along seasonal lines, but there's still more than enough activity moving at this point in time to increase the DUC count and to give us a decent runway when you look at next year, especially when you look at Q1 and into Q2. And again, puts, I think, what our consideration is for actual production levels of about 12.3 million into barrels per day to the end of the year, and then an increase next year to about 12.7 million. Now, with that being said, we have to look at the price cap. And one of the things that we've been saying is that Urals are already trading well below the price cap that they've been talking about. They initially discussed $65. Now they've made an agreement to $60. But and let's just be very clear. Nobody who buys ESPO is participating in this price cap. So ESPO is trading above the price cap. It never went below it. It never was going to go below it because that is already going into Asia and is already in a position to flow into China, and India and other areas. So again, there's not much to be talked about on ESPO. The focus is really on Urals. So when you look at it, there's also a provision to make sure any resetting of the cap should leave it at least 5% below average market rates. But market rates and where Russian crude is trading is really, there could very well be 30% discount. You're not looking at something that's going to be back and forth. And the one thing that's interesting is there was a lot of handshaking that they took money away from Russia and they did all these great things. But and I'm not laughing because it's funny. I'm laughing because of the absurdity when you look at politicians, was that the price of Urals actually rose after this was announced from $45.31 to $48.04. So when you look at it, you're going to see prices go higher and get closer to that cap because, well, now you would legitimize buying crude. Like, I can buy Russian oil and still be under the cap. Again, Russia can come out and say, we're not going to sell to anyone that has that participates. They can play whatever games they say they want to play, but they need money. And if you sell this, then and to be clear, it was always a point where they didn't want to stop the flow of Russian crude, but they did want to hurt their revenue. But as we've been saying, Urals are already trading so far at a discount that any type of price cap is going, and that's why if you went at 30, it's like, okay, well, that's well below where Urals are struck. So it's interesting when they look at market rates, but then you have to look at it, where are the actual Russian barrels trading. So the other thing that it introduced is a 45 grace period for vessels at sea that loaded their cargo before Monday, giving them until Jan 19th to unload the oil, as well as a 90-day transition period for any future change in the price level. So that's just making sure that nobody's going to get sanctioned, that it's like, look, we already had this. We can't dump it in the ocean. We can't just sell it outright. So it's just a way to protect the ship owners themselves. And most G7 nations will stop importing Russian crude by the end of the year. An EU ban, and this is, I think, an important one, an EU ban on other refined petroleum products originating in Russia is due next February, alongside a cap on those goods. Now, it's good that they waited until February to do that because they're still going to need all of their diesel. But that's going to become another, again, pivot point into where can they come up with some agreement? How does this look going forward? But clearly, and again, that not only just is it still cheap enough to buy it, but there's also a lot of ways around this price cap, from paying Russia from separate banks, one that is in the Europe and US, that are beneath the cap, pay the difference through a Middle Eastern or Asian bank. Again, there's things that can be done to, again, circumvent these kind of loose levels. Now, when we look at the U.S., November ISM manufacturing came in at 49 versus the estimate of 49.7. So it was already supposed to be contractionary. It came in much lower than before. So now when we look at things that are happening going forward, new orders dropped to 47.2 versus the estimate of 48.5, getting much worse. Prices paid sank to 42, which is a positive in the sense of prices coming down. Employment fell to 48.4, which is, again, moving further into contraction. But we want to talk a bit more about the employment side because that's where there's a little bit more back and forth. So then when we look at what's happening in the personal consumption side, as well as personal income. So when we look at PCE inflation, because we want to look at core prices on the consumption side. So October PCE inflation came in at 0.3 versus the estimate of 0.4. So again, it's still increasing. Inflation is still going up. It's just going up at a slower rate. Other October personal income came in at 0.7 versus the estimate of 0.4. Fastest gain since October 2021, and personal spending came in at 0.8 versus the estimate of 0.8. So it's interesting because you have inflation that's going up, but now you're actually getting income accelerating. And we want to break down what does that mean, because the biggest thing that they want to avoid is a wage spiral. And given where now wages are still remain elevated, coming down a bit in some areas, but still remaining elevated. But at the same time, you still have a very tight employment market. You have labor force dropping off. So there's things that we're going to have to look at in the near term. So when we look at things that are happening in the U.S., 2-month payroll net revisions, when you look at non-farm payrolls came in with an increase of 263,000 barrels. The estimate was 200. So again, better than expected. Unemployment rate still at 3.7%. Average hourly earnings was expected at 0.3, came in at 0.6. But the work week is getting shorter. So labor participation is going down, the work week is shortening, and unemployment is still rate is still low. So there's some different levels of interest, and we're going to go more in depth in the Econ Show next week. But there's something within that that again is a bit confusing when you look at some of the different data points. One of them being job cut announcements, which are up 460% year on year in November, significant increase from 48% prior and largest jump since July 2020, 24% of cuts due to cost cutting, 16% to market conditions, annual change in hiring rate for information on the JOLTS side. You can see that the JOLTS data coming in slower. So again, this is more of the leading indicator. And then so the Challenger JOLTS is showing you what's coming. And then when you look at the payrolls data, that's kind of just confirming, are we there? Where are we on this cycle? And then when you look at unemployment, move higher in permanent job losses which is that blue line, while temporary unemployment ticked down. Working less, average weekly hours cut in November from 34.5 to 34.4. So people are working less, getting paid a bit more, but working less, which is important when you consider government transfer payments. Share of personal income moved up slightly. But when you look at personal savings, as of October, now at the lowest since July 2005. So there's a lot of stress when you look at spending, and we're going to come back to that chart in a moment. Because here you look at October, personal income was at 0.7 versus the estimate of 0.4, but personal spending came in at 0.8 versus the estimate of 0.8. So when you look at, first this chart, when you look at the levels of earnings, which is that blue line, the average hourly earnings ticked up a bit, but the hours all employees keeps ticking down. So that's you're getting this bifurcation. So personal income fairly stable, but as the savings comes down, and where is the money going to come from a CapEx perspective, from a company perspective, to pay these individuals? And that's when you have to pass through prices, which is why even though some prices have come down, you've seen some of that decline. You're not seeing a huge drop because you still have to pass through some of that additional cost. You still have to move through some of those different pieces. Personal savings rate. Now, this is the important piece because the income trend is weakening. So we know the income side is weakening. And that's again, inflation adjusted because we do have wages going up, but inflation is still going up. So the income, like what's coming into you, is weakening. The savings dip is unprecedented and unsustainable. And the credit splurge is the biggest risk. So when you look at some of these different pieces and now cycle that into what's happening around the world, November global manufacturing PMI fell lower by 0.6 to 48.5, remaining below the 50 threshold for the third consecutive month. The only region with a manufacturing survey above 50 is Asia ex-China. But then when you look at world manufacturing surveys, activity versus price component, the falling manufacturing PMI is due both to a decrease in activity and a more significant decline in price pressures, which is good for some of that inflationary pieces. But as we talked about, as some of that comes down, we have some other pricing pressures coming up, keeping us in that stagflationary period. Delivery times have now shortened for 7 months in a row due to fewer distortions, supply chain issues, but also due to the slowdown in demand. And that's the key piece that keeps getting missed. The demand keeps getting weaker. So what is that? The demand in world deliveries, is what? Trucking, is shipping. When you look at manufacturing, a lot of diesel, a lot of things within that, that's all coming off. And in this is a particular evident in developed markets where delivery times have returned to pre-crisis levels, which, again, that's that flow back, as we talked about last week and the week before, with the leading indicators in OECD nations coming down, coming negative in contraction, and how that takes time to whittle through. And all of this really leads to a slowdown in oil demand, a slowdown in diesel demand, which we continue to see play out. So that's what we have for you today. If you have any questions, please let us know. The one last piece is the Canadian data has been updated this morning for the FSC. So if you get the information from our outputs, you will have the new Canadian data. So again, thanks for watching, and we hope you have a great weekend. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.